Hey everyone, hope you guys are enjoying your weekend. Today we will talk about a very important topic, which is the market logic, direction, and targets. The goal is to make this complex puzzle a little bit clearer to you guys, how the high probability trades and scalps are actually born, as one thing that I've noticed that everyone wants to know about the most is the entry pattern. I think I will shock your world by saying that the entry pattern is probably almost the least important thing that you need to know, as you understand the OTE, which is a simple retracement to a high probability area after a nice and clear displacement, that could come in a few shapes and forms, but ultimately it's the same thing, than the model that we've already talked about and I've presented to you as first one, because it's the one that helps traders who are not yet too confident about their trading and skills, still keep a pretty solid win rate. So, all this is so to say sexy, but you already understand this part, and yes, we will dig deeper into the OTE and institutional entry order flow drill etc., which is in very simple terms just a quick break of the previous structure, which becomes inducement, as we call a fake low or high, when price just runs it into the imbalance, and price then shoots with the main direction. This usually happens on the late phases of a market maker model, when the price is getting close to the original consolidation, which is the original draw on liquidity that we're focusing on, so the price usually stops building those complex patterns there as it's in a rush to complete the model, and just run the target, so that's where usually it happens. Circling back to the main topic, understand that entry is not the main thing to success, just simply focus on the order block that's overlapping imbalance, and is around the 0.62 OTE fib level. That's it, that's your entry pattern right here. Stop looking for all that fancy trading science. So, now that you have the entry pattern, understand that what actually creates the opportunity is first, understanding where the price is at right now, where it's pushing on the long-term vision and on the short-term vision. So, if let's say we have a bearish order flow on the daily time frame, meaning that the price is pushing towards a higher time frame imbalance and or sell-side liquidity pool, respecting bearish PDAs and breaking through the bullish ones, as day traders, are so to say long-term trades that we look for 50 to 70 pip swings now are to the downside with the daily time frame sponsorship. Now where the scalp plays are born are mostly two phases, when there's no actual daily direction and both daily and 60-minute charts are pretty much stuck in a range market, or, listen carefully now, when there's a level that price must hit in order to get in sync with the higher time frame direction, we focus on the 15-minute and 60-minute liquidity pools. That are the ones that must get ran in order for the lower time frames to get in sync with the higher time frame logic and direction. What this ultimately means is that we recognize the liquidity pool, and usually an important PDA like a 15-minute or a 60-minute fair value gap or an order block, that price will most likely have to run into, in order for the daily momentum to continue. This scenario creates a situation for us to look for small, short-term liquidity pool sweeps. That turns into smart money reversal patterns and market maker models towards that 15-minute and or 60-minute areas, that price will have to reach, before we see it trade with the daily momentum again. So, that area of interest becomes the target for our scalp play. This is when we focus on targets around 15 pip, 20 pip and 30 pip marks, aligning them with opposing PDAs, extension levels, and so on. Once we have that framework in mind that okay, daily is bearish, but now on the lower time frames price is not ready to move from here, what is the potential area that price will have to run into in order for the lower time frames to make sense inside a bigger bearish framework, that becomes the direction for our scalp trade. From there we have the direction that we want to identify if there's a potential market maker model in play, and what area could be our original consolidation. From there, once the smart money reversal happens, to take the first entry is always a bit risky, and personally not my cup of tea even though it is valid, but if we want more clarity we take it on the two-level entry once we see it start going. That's when we can look for a nice move towards that 15-minute and or 60-minute area of interest. So we take the trade, ride it towards that zone. Once the price gets there, what happens next is we want to be completely out of our positions, and start thinking about a bigger position that will go with the daily sponsorship. Just remember that usually, it won't happen in the same day. So, circling back to the beginning, remember that everything starts with observing where the market is, where it's going on the bigger picture and where it's going on the medium and on the small one. Once we know that, it's when we start to wait to see if the price will want to play ball with us. If it does, and it acts exactly as we wanted it to, that's when we want to see a way to get into that move when now we know where it will be going. So as I mentioned in the very beginning of this video, notice how the entry is literally the last piece of everything. You could have the worst entry technique on this earth with a 1-to-1 RR and still be profitable by being good at identifying the target, the draw on liquidity, and then once you know that price will go there, just buying a ticket for the seat in that train towards it. So, this lesson was something I really wanted to talk about before Christmas holidays, but it was slightly delayed, so this week's events inspired me to now dig deeper into these crucial factors of how good opportunities are born. Hope you guys learned a thing or two, and we will talk soon. Take care and enjoy your weekend.